Welcome again to our podcast, Decoding Gaming Law. I'm your host, Franklin, and today we have a special guest, Dr. Malcolm Falzon, partner at Camilleri Preziosi Advocates. Malcolm, thank you so much for being here. Tell us a bit about you before we start delving into the capital markets industry.
So, pleasure. Thank you for having me. Thank you, Franklin. Thank you, Sigma. So I am a partner at Camilleri Preziosi, a law firm based in Valletta, Malta. I work mainly in capital markets and gaming, which is why the topic of today's podcast is of particular interest to me. From the gaming side, I think my work has evolved over time, as did the industry locally, from originally being purely, regulatory, and then the setup of organizations here in Malta to move on to financing, and now quite a lot of what I do on the gaming side relates to mergers and acquisitions and in fact capital markets, be it assisting operators in the context of transactions which are M&A transactions but may have a capital markets element because those entities may already be listed on an exchange, typically so far at least outside of Malta.
Thank you very much for that introduction, Malcolm. So today the topic will be capital markets and the benefits or non-benefits of having an initial public offering for those gaming operators intending on going public. And the first question to you is this: why would a gaming company consider going public, and what are the strategic benefits of listing? I'm also interested to know the disadvantages, for example, loss of control. So that is my first question to you.
All right, interesting one. So to start off with, listing on an exchange is not for everyone. And when we speak of listing, I think it's important to make the distinction between access to the equity market or access to the debt market. So trying to cut quite a long story short, in the case of the issuance of debt instruments, so typically bonds or notes, here essentially you have an entity which approaches the market, so the investors, which could be institutional investors like banks and professional investors, but also the man in the street, who would be looking at investing in issuers which come about on the market, looking to borrow essentially. In this particular case, you would have debt instruments which would be subject to certain conditions, and in return for the lending effectively granted by these investors, such investors would then be entitled to receive a return, particularly principally in the form of interest. So when you hear the term coupon, that would be an interest rate attached to that particular instrument, and that interest rate would be determined in part by the market, but also by the peculiarities of that particular that issuer. Obviously, there are certain issuers which go to market carrying a certain level of risk, which may be higher or lower than other existing issuers. But also that rate of interest may be affected by the conditions of the market at that time.
And why would an operator go for debt instruments rather than equity? Is it because they're less risky?
The aims are very different in that case. So in the past, most people would say that tapping into the debt market is primarily an alternative to traditional financing, so to bank financing. Listen, I haven't secured the conditions I would have wanted from my typical lenders, and therefore I will tap into the capital markets. Over time, I think that mentality has changed, and you will have a number of issuers which will have a combination of debt financing from the capital markets and bank financing. When opting for debt financing, typically I think the targets would be, and this ties into your earlier questions as to what benefits would typically be associated with a listing. The key point is access to funds. access to funds, which in turn enable that particular operator to really diversify its strategy, to grow research and development, bring in the kind of resources and talent that perhaps before it wasn't in a position to attract. Another benefit of a listing, be it debt or equity listing, is also the reputational gain that is intrinsically associated with a listing. The fact that you as an operator, whilst remaining in line with your requirements and obligations as a licensed and highly regulated entity, have also gone through the process of a listing, which is not necessarily a walk in the park.
You're adding value to the brand as well.
You're adding value to the brand. There's a level of prestige, and you form part of a club which is obviously much more restricted than the wider club of, all any, gaming operator under the sun, be it B2C, be it B2B. And in fact, there are a number of gaming operators which have listed. There are a number of gaming operators which are hugely successful but have not listed simply because listing on the capital markets is just not aligned with their strategy.
And what could that be? Like, what strategy?
Yeah, so let me give you an example. So let's start off with the fact that no gaming operator on day one, the moment it starts his business, is going to set off as a licensed entity, as a listed entity. And here I would make the first distinction. So you have instances in which operators are set up as not a one-man show, but very a close-knit group of people, at times possibly family. Okay, and for as long as those relationships among the founders remain healthy, then there may be a genuine sense of fear or not wanting to lose control.
Exactly, the loss of control.
Loss of control. And now I think the degrees of loss of control differ significantly between a debt issuer and an equity issuer, in the sense that when, in the case of a debt issuer, as such, the reduced control is represented mainly by the fact that the board of directors can no longer be composed only of those people who founded the business, or maybe the close-knit group that grew over time, but there would be the need to involve independent non-executive directors.
Exactly.
So non-executives as carrying out an oversight function, a check, control and balance function with respect to the executive.
I think also listing on a stock exchange, apart from, basically you're stripped. There are public disclosures.
Yes, that's a very important point. I mean, you are no longer traditionally, I mean, apart from the advertising which you would carry out, and obviously we know that when it comes to the gaming ecosystem, advertising is very high on the agenda.
Yes.
So operators are quite content at times to give a sense of how successful the business is. In the case of a listed entity, then that becomes actually an obligation.
Exactly.
So it goes beyond simply publishing your audited financial statements on an annual basis, but there are obligations to publish company announcements which keep the market informed, whether they're your bondholders or your fellow shareholders, keeping them informed as to matters which are material enough to warrant or to merit the publication of announcement, the providing the market of an update. In terms of the going back again to an equity listing, I think the main strategic difference there between equity and debt listings is that in the case of equity, you are actually shedding some of your shareholder control.
Exactly.
Okay? And there are minimum thresholds at which you can be doing that. So in the past, as things stand, let me give you an example under Malta's capital markets rules, which are the rules which any issuer listed in Malta needs to abide by. The law provides that if you are going to go public as an equity issuer, then at least 25% of the share capital holding voting rights in the company needs to be held in public hands. Okay. So that would exclude effectively the shareholders which have brought the company to market, and it would exclude directors holding shares, and there are a number of other
It's quite a chunk, 25%.
Yes, and in fact it's been a long-running debate that this 25% is significantly high when you consider that for certain decisions at shareholder level, that may potentially strip the incumbent shareholders, those who brought the company to market, of the ability to carry certain decisions themselves. There have been discussions at European level with a view to revisiting the 25%. In Malta, us and a number of other practitioners, not only lawyers but also stockbrokers, financial advisors, have been pushing the authorities to reconsider this 25% threshold. One basic argument is that 25% of company X is not the same thing as 25% of company Y.
Exactly, the very case by case.
So there are actually, when you float, when you go to IPO, you obviously want or at least the majority of the shares being floated to be taken up by investors. And there is a limit, obviously, across markets as to what appetite there is for this equity. So we look at the Maltese market. The Maltese market is
the Malta Stock Exchange.
The Malta Stock Exchange. So in Malta you have a number of regulated markets. One is an institutional one, but where we typically associate an IPO with is the official list of the Malta Stock Exchange.
Okay.
On that list, the chances of being able to list a company with a very high valuation and obtain the take-up of 25% of that is going to be significantly harder than it would be to list 25% on maybe larger markets like the London Stock Exchange or NASDAQ, another market which is very popular when it comes specifically to gaming operators, would be NASDAQ First North, for instance. And there, that one of the reasons for that is because the captive audience there, when you speak of investors, which particularly Scandinavians or those who are exposed to that particular market, are also, breathe very much, breathe and speak and talk the gaming language, so to speak. So Malta, as you know, has evolved as a very popular gaming jurisdiction. As to whether the investor base is as enthusiastic in investing in gaming operators which may choose to list in Malta as opposed to investors in other markets is to be seen. But the likelihood obviously is that yes, the chances of a wider take-up by a larger investor base would be higher in larger markets, as logic dictates.
And a Maltese gaming operator can list wherever in the world, or are there any restrictions? Or yes, subject to the restrictions of the host?
It would be subject to the restrictions of the host. Sometimes it really depends on. So I recall one particular instance where we had a local operator, which was where the setup was entirely Maltese. The people behind it were not Maltese, but the company was set up. Well, the group of companies really was set up in Malta, and when it reached IPO stage, the choice taken at the time was to list on NASDAQ New York. And there, the choice was, listen, perhaps we may have part of the investor base may have a preference towards investing in a company which is based elsewhere other than Malta. And you have instances in which an operator would, pre-IPO, would, for instance, redomicile to another European jurisdiction, say Ireland in this particular case, or elsewhere. But no, subject to the particular requirements of that specific exchange, there would be nothing which prohibits a Maltese company from listing outside of Malta.
And since you already mentioned some of the requirements, and we're soon nearing towards the end, possibly we might have another episode of this as well. Like it happens in every episode, the topic is very vast, so it makes sense to split into another episode. Can you walk us through the typical process a gaming company undergoes to prepare for an IPO? So what we want to know is sort of what would be the first step and how long does it take usually? Of course, it's subject to the approval of the listing authority, in Malta being the Malta Financial Services Authority, the MFSA. So what are the key processes for an IPO?
Okay. I think the first one is an internal one, which is a cultural mind shift. The fact that you are prepared to move from something which is entirely your own and which you have directed in the way you wanted, subject to the requirements of the gaming regulator, in Malta's case the MGA, or obviously nowadays, or at least in recent years, regulators from other jurisdictions. As more and more markets opened up, then obviously the exposure to more and more regulators came about. So it's really that cultural mindset and the ability to say, or the maturity to say, okay, I am prepared to bring in strangers, at least as at today, to be sitting around the decision-making table with me. The acceptance of the fact that there are certain things which before you may have wanted to keep to yourselves, also not to give competitors any particular advantage, but having to disclose certain information which before need not necessarily have been disclosed.
So that would be the sort of initial advice. If someone a prospects come to you and tells you, I want to, go for an IPO.
I think the first question would be, okay, mentally, culturally, are you prepared for this? And you explain what this would entail in terms of corporate governance, extremely important, having the right governance setup, internal reporting, from a financial reporting perspective, certain more basic things like, are you already reporting on an IFRS basis, International Financial Reporting Standards? Do you have a track record which is good enough? So you need to have typically a 3-year historical track record to be able to approach the market.
The addition of compliance costs, I imagine.
Addition of compliance costs. The process itself, I mean, there's also a number of advisors which need to be brought on. So the prospective issuer would need to bring in a sponsor who would be the interlocutor between the operator or the prospective issuer, and the Malta Financial Services Authority, or the exchange, if outside of Malta. Financial advisors, or maybe there would be the need to change auditor, because in the past you have been making use of the services of a small outfit, whereas you feel that if I'm approaching the market, I may need mid to high tier auditors in order to kind of add quality or add veracity here, for want of a better word, to the brand.
And sorry to interrupt. In terms of timeline, I know it's very difficult to establish a concrete timeline, and time frame, because it varies from one to the other. But on average, and considering MFSA approval or any other approval listing authority, how long would it take?
A lot really depends on how prepared the issuer is at the point in time of approaching the market. We have had instances in which going to the debt market, so in preparation for a bond issue, the process may have taken as little as 4 months. I know little might sound strange to some, in this industry, 4 months sounds like a long time. But
to me, it sounds very short.
In the capital markets, it might not be. But 4 months is, typically in the case of a repeat issuer or an entity which may have already listed outside of Malta and may be coming for a dual listing, or really has everything in place at the point in time of approaching the regulator. But we have had instances of debt issuers which have taken close to a year to actually get their bonds issued. In the case of equity, I'll be honest, IPOs have been few and far between in the last few years. In Malta, just to give you an example, there was one IPO in all of 2024, but it's not a Maltese phenomenon. In Spain, I believe last year there were, I think, 4, if I'm not mistaken. So it really depends. It really depends on the market and what the mood in the market is at the time. Today, May 2025, with all of the uncertainty and volatility we have in equity markets, it is unlikely to be it may not necessarily be, let me not say unlikely, the ideal time to tap into the equity markets. However, my advice would be that if there is that prospect further down the line, then preparation is key, and therefore coming up with the right strategy for an eventual IPO, bringing the right people on board, the right sponsor, financial advisors, legal advisors, of course, I could not mention them.
Of course.
But yes, having the right team around you and starting to prepare and build that story and strategy, and even getting your own people on board, getting your own employees invested and saying, listen, you are now going to be part of something which is not only us, and potentially even coming up with incentives for these employees. Now, you being offered equity in a listed company, which obviously carries certain benefits, certain advantages than holding shares in a private business.
That sounded very much like your concluding remarks. But is there something? I think a key takeaway, what we discussed, is sort of you need to prepare yourself, changing your mindset and internally, as you said. But is there something else that you would sort of would recommend? Also, sort of what would be particularly attractive around the world when listing?
I think really the access to capital. In the case of equity, there is the added benefit of providing an exit opportunity for a number of the incumbent shareholders who have started the business, grown the business over time, and see this as an opportunity of selling out a proportion or all of their shareholding in that company, and reap the benefits of their hard work over the past few years.
And it boils down to contractual agreements, really, and really making sure that the memorandum, the registered notes.
Yes, obviously the conversion of this company from a private company to a public limited liability company. The M&As need to align with certain requirements of the capital markets rules, but these are, again, part of the process. I think the key point is getting the right advice. And really acknowledging whether this is right for you and whether your business is fit for purpose, is fit for listing, and that you have the right people on board who are going to ensure that, just as you have remained compliant with your gaming regulatory requirements and obligations, you are also in future going to be able to abide by the rules of the game of this new playing field you've now found yourself in, which is the capital markets.
Malcolm, thank you very much for being here. Time flew by, as always. And thank you for our listeners for watching us.
Thank you.